Hello, everyone, and welcome to Woody's Weekly Wisdom, episode number 27. And thankfully, today I've got something that is pretty interesting and slightly positive. So, headline: RBA interest rate moves pay off, but clouds remain for homeland. So, you know, unbeknownst, or in classic style, the journalist couldn't just write a positive article, had to throw on a little bit of negativity at the end about some clouds remaining for home loans. But the article in general is pretty positive. So let's have a look at some of the things it's saying. So effectively, what it's saying is we've seen that the interest rates remain on hold again this month, which is great, and very helpful for everybody who's in a borrowing position. And let me just get that out of the way. And basically, it's saying that there's still a bit of a tightrope between interest rate rises and economic Armageddon, but generally things are looking a little bit better than they were previously. So they've kept interest rates on hold, third consecutive month in a row, and basically now the conversation allegedly is switching to when will they start to reduce rates. So that's interesting, and classic journalism, media is if rates aren't going up, they must be going down. We have to start talking about one or the other. We can't just be sitting here in limbo. And it's interesting that will continue to play out. But what this article talks about is the fact that we, households and businesses, have done what the Reserve Bank wanted us to do. We've curtailed our spending and we've kept a cap on prices. So one of the biggest fears that they had with interest rates rising so rapidly was that businesses would not necessarily take advantage, but would be forced to increase prices in order to deal with their interest rate burden. And those price rises would put more pressure on inflation, and we'd be in this circular argument, which I've been arguing we're in anyway. But this would put more and more pressure on inflation as prices rose, and that would then lead to employees demanding wage increases to keep up with the rising costs. So it was a very, very, I guess, tense battle and a delicate battle between who was going to win and who was going to do what the Reserve Bank wanted them to do. So the article basically points out that inflation is diminishing and coming down nicely, and I guess in accordance with what the Reserve Bank wants. And we haven't seen those price rises across the board. There's no doubt when it comes to things like weekly groceries that people are seeing price increases, but it's not been as broad or widespread as was feared. It does touch on the fact that Australia is doing quite well with its inflation. It's now down to 4.9%, well below where it got as high as 8.4%, and a lot better than Turkey, where it recently spiked to 59%, which led to interest rates going from 17.5% to 25%. Now, I've just been in Turkey, and I can tell you that there was some behaviour there that suggested that, yes, there's a lot of pressure on businesses and just everyone's livelihood over there, because there was a reasonable amount of selling pressure in certain parts that we were exposed to. But generally, it was an amazing place to be. But clearly, with interest rates at 25% and inflation at 59%, Turkey is in a very, very difficult position. Australia, on the other hand, down at 4.9%, definitely heading towards the numbers that they want to see. And like I said, wages growth has not spiraled as feared, and so the economy may avoid a technical recession, and that's That's a great thing. And so there is some applause for the RBA for doing the right thing. So then, rather than wrap up the article with all the good news, we need the sting in the tail. And so the sting in the tail is the fact, and I've alluded to this on previous weekly wisdoms, is that the last quarter of this year is where a large volume, and this is this paragraph, this dot point, not that one, this dot point here, where it's talking about the 900,000 fixed rate loans that are coming off their low interest rate this year and reverting to the variable rate, which is 4% higher than the fixed rate on average. Some people are going to experience much more than 4%. But there's significant variation from a fixed rate around the 2% mark to a variable rate well above 6%. So that's a lot of people who are about to suffer, interest rate pain for the first time. So some people have been coping with it for 12 plus months as rates went up every month. The people on the fixed rates have been sitting back going, it doesn't affect me, I'm all good, and they're about to join the party as such. And what I suspect that's going to do is put, because 900,000 borrowers is a large number of people. That is going to put a lot more downward pressure on inflation, because there's going to be there's 900,000 households who are going to have to look more closely at their spending. And if they haven't already, they certainly will when that kicks in, and that's going to put a lot more downward pressure on spending, and therefore prices, inflation, and ultimately interest rates. And the second bullet point here talks about the lagging effect of interest rate rises. So we still haven't felt the full impact of all of the interest rate rises. So that's still to come. And and then it talks about people are starting to dry or get through their accumulated savings that they built up during the pandemic, which I think a lot of people have done that well and truly already. So it's a delicate phase, but the positive is that the population in general has reacted in the way that the Reserve Bank wanted. So you've reduced your spending. Businesses haven't put prices up out of control, so that's helped. So that hasn't put wages pressure, which is just then creates this circular inflation dilemma. So that hasn't happened yet. So there is a possibility we'll avoid a recession. So that's all good news. And when it comes to your personal money management, there is, I guess, light at the end of the tunnel. There's a possibility that in 2024 we're going to start seeing interest rates come down. And so, as I said before, if they're not going up, the conversation will switch to, well, when are they coming down? And that is happening. And the data that this article is reflecting on, and we're seeing across the board, and we're seeing overseas as well, seeing this in the USA as well, is now suggesting that the more likely scenario is that interest rates will be able to be eased a little in 2024. Now, don't expect them to rush back down to where they were at all-time lows, because they were all-time lows, so they're not going to rush back down there. But some easing will enable your personal household some reprieve, and hopefully more that reprieve is an opportunity for you to put that money into your Pay Yourself First account and get it working for you. So if that's something that appeals to you and you want to know how about making that happen and how to get your money working for you so that you can secure your financial future, leave us a comment down below or reach out in the DMs, however it is that you want to make contact. And let's start the conversation about how we might be able to help you get down that journey of securing your financial future by using some of your money to work for you rather than the other way around. So as I said, a reasonably positive article, some pretty good stuff coming out, and at last there may be an end to the interest rate rises and a little bit of reprieve in our weekly shop when prices start to ease because interest rates are easing down the track. So good stuff. As I said, if you want to learn, how we can help you to manage and grow your money, reach out, leave me a comment, shoot us a DM, whatever it is that works for you. And don't forget to at least like, comment, or share these posts so that more people can see them, and we can get the message out to more and more people. Have a great week. That's Woody's Weekly Wisdom, episode 27 in the bag, and we'll see you again next week. Cheers.